your appetite for risk has less to do with your personality than it does with what's going on in the market at the time of things. So don't sit there and blame how you are, your anxiousness, on how you've been feeling the past few days with what we've been seeing as of the time that we are reporting this podcast episode. I'm Heather Branch. This is Mike Douglas, certified financial planner, a.k.a. Michigan's retirement coach, here to help you get some insight on things that are happening now, things that could be happening in the years ahead. More importantly, having a plan that works to add safety layers to your savings while you're in your retirement. So despite Wall Street or Washington, D.C., you're just trucking along, smiling and swinging in your hammock and sipping your sweet tea and just having a nice old time. Isn't that the goal, right?
Yes, nice and easy.
Obviously. That's it. Nice and easy. Thanks to the plan that you, sir, Mike Douglas, have helped us build at LifePlan Financial Design. That is the name of the game. MichigansRetirementCoach.com is our website and where to start the conversation with Mike if you have questions. We also have links posted in the show notes. So let's talk. Well, first off, the whole conversation around what's happening in the markets this week. You can give us some intel on that. Do you want to touch on what we've been seeing? And because you said your phone's been blowing up.
Yeah, there's a lot of volatility right now, obviously. We have to keep in mind, and we know this, but we need to be reminded of things sometimes, that the market is very speculative. It is not looking at today. It's looking at, a month, 3 months, 6 months out. And so when you have news today that people feel will be positive or negative in the future, or that they can't predict in the future, they hedge negative. So right now we are in a space where the news cycle is very, very short. With President Trump in office, there's a lot of stuff happening, quite a few things. And it's interesting when you go down the list of saying he came in with certain agendas of things he wanted to accomplish, and we're, 45 days, 50 days in, something like that. And people are upset that everything on the list isn't done yet. And it's like, it's 50 days into a 4-year term.
See, I feel like it's been nothing, but I'm like, why so aggressive? Why does it have to? I feel the opposite.
So there's two schools of thought. One side is saying, can you just chill out a little bit? And the other side is saying, what's taking so long? And his base is saying, what's taking so long? The other side is saying, you're trying to jam 4 years of work into 100 days. But in his mind, I got really 18 months before midterms start rearing their heads, and I got to, make some hay while the sun shines. So right now, a lot of tariff talk, a lot of international talk. There's issues with Iran, issues with all places around the world, a lot of threats going out. So the market is saying, we don't know what to predict, so we will hedge negative. And that's the way. So if they think things are volatile or speculative bad, or the unknown, they'll say, well, then the market will dip, people will pull out of equities, go to safe positions, and then only when they see good on the horizon will they go back into the market with equities. So we're seeing that hedge to negativity, and when the hedge to negativity happens, the market does fall out as a result. There's no major economic changes that have actually happened yet. We've seen, obviously, Doge do their thing, and they're kind of still working through and chopping things and then bringing some things back. But again, the whole idea right now is a culture shock to say business as usual will not continue. So that is happening. Then it's a matter of how the rest of the world responds to the tariffs over the next 6 months to determine what the actual policy results will bring us. So again, a lot of speculation, a lot of movement in the market, but it's really just based on we don't know, so we're going to hedge safe, which then pulls the market backwards.
Okay. Well, for folks who are the folks that you work with, getting close to retirement or already in retirement, market volatility, it's a whole nother level of concern because you're not in your earning years anymore. This is now the time where you're spending down your money, and market volatility can work against you because of the idea of sequence of returns risk. So now you're drawing from a portfolio that is less in value. So essentially you're double downing, if you will, in a bad way on what you have worked so hard to earn and save. And obviously risk tolerance is a conversation that we have had in prior conversations when it comes to our tolerance levels and what affects it. It's actually, according to this article on Kiplinger.com, they're talking about how many times people's appetites for risk is not determined by their personality, but it's in fact reflected by what is going on in the market at the time. So, to use gambling terms. And the idea is, again, thinking about double downing. If you were in Vegas and you were on a winning streak, you would think much more positively and speak much more optimistically about the game versus being on a losing streak. And you're like, it's rigged and it's all for the casinos. The mentality apparently is the same when it comes to our market risk tolerance. I think that you're agreeing with this sentiment. What is the danger in that space, particularly for retirees, that mental space?
So what we really want to avoid is recency bias. Recency bias is just our hyper awareness of the things that have gone on in the last week, 2 weeks, a month. The things that have happened right now affect us emotionally the most, but typically financially the least. So we want to not let that be the thing that it determines our future. The market's going to have bad times and good times. And depending on the window you look at, it can be really bad or it can be really good. But over time, we know that the market tends to trend itself upward. So when we are building out plans, we don't want to treat it like it's always going to be like it is right now. You want to build financial plans from a place of emotional stability and financial stability. So we look through and say, all right, over the next 20, 25, 30 years of your life, there may be 10 years that are negative in the market, but typically 15 to 20 years that are positive. And those positive years will tend to drive your money higher. So, but if we look at our money not just in terms of one big lump sum, but think of it in terms of purpose and timeline. The money I need for income for the next 5 to 10 years, I don't want it to be speculative. I don't want it to be risky. I want it to be more fixed than the money that maybe I'll never touch. Maybe it's your Roth IRAs or money that you're going to leave for your kids or grandkids, some old stock you bought, whatever. That needs to be more speculative, more opportunistic, because over time the market will do it the favor of growing, even if there's bad years. So rather than just looking at the whole thing and saying, and that's what I don't like about typical risk analysis, they say, you are moderately conservative. So we're going to try to not lose a ton, but also not make all the gains. And it's a generic term. I like to think of it very specifically. I need $2,500 a month of income, whatever the number is. All right, then we need to take a chunk of money and solve for that, whether it's through a dividend portfolio, preferred stocks, an annuity, life insurance, something. We need to find a way to secure that income plus inflation for the rest of your life. Then the remainder of your money can be opportunistic. But that's because I know that my monthly paycheck is never going to be messed with. It will always be there for me. So the reality is that we can build plans that say, I will be okay, we will be okay, and our paychecks still show up. The most fearful spot for people is when their lifestyle is at risk. I had 2 emails come in this week. One was from a client who is traveling the world, and one is someone who's traveling the country.
They're both spending money, and do they have the money?
That's all. And they come from completely opposite political spectrum. As the thing, like one is very right and one is very left. But it's so funny though, because we talk about how unique people are. Yeah. The concern is the same. I'm traveling. I don't want to be looking at this. What is our plan to make sure that we keep moving forward? Yeah. It's as simple as that. And it's a beautiful picture of that we really are the same at our core, right? We need security, we need safety, and we need to have purpose and joy in our lives. And so whether, you're the one who's as left as can be or the one who's as right as can be, they both are saying, the market's doing this. I want to keep living my life. How do we make sure this keeps happening? That's where these conversations come in. It's not so much about trying to pick the magic stock. It's not about saying, well, I'm going to try to market time and get out when it's bad and get in when it's like just really like you do want to be protective. You do want to have hedges. You do want to have some proactive planning that says if things go bad, here's how we react. If things go well, here's how we take advantage. But that needs to be not from today stunk in the market, let's make a decision, from a stable place of here's where I no longer am acceptable of loss, here's where I'm no longer acceptable of missing out on gains. And we just kind of move from there. So again, I just think that retirement planning is really in the eye of the investor, not the advisor, but the investor. It's much more urgent, and it should be because it's your money, it's your life savings, it's everything you've been working for. But the reality is the reason you hire an advisor is to help you in those difficult moments to see the forest for the trees, to help you continue to maintain a long-term view and make short-term decisions off a long-term view. If it was left to all of us to make our own decisions, right, in these moments, that's when the chaos ensues. We all freak out. We sell out of the market, which causes the market to tank more. And then we're like, see, I told you it was a bad market, but because we pulled out of the market, it lost more. We want help in those moments. That's why, in every program, the players don't call the plays. A coach who's on the sidelines safely, or a coordinator who's up in the booth safely, is the one calling the plays. And the reason being is because they have a better perspective of the whole field than you do as a player in your helmet, watching just right down the middle. So they have a better view, a better idea of what the long-term opportunities are. So in the same way, advising for financial people in retirement is about protection first, opportunity second. Typically, there are some situations where we really want to go for it. But again, just in moments like this, when there's political volatility, market volatility, a lot of speculation, potentially a lot of opportunity around the corner, or potentially a recession around the corner, are we built for both? Right? And so it's not a right or left issue. It's a my life and my family issue. And that's why we try to build stable plans for both situations.
Okay. It sounds to me as though the lesson here is much like you have said before. And generally, I think people, especially retirement-focused advisors, that they say to stop focusing, stop obsessing over that big number at the bottom of your statement and start focusing on the income that statement generates for you. We need to have the same perspective as far as our risk goes. We're so focused on the bottom number and what the ups and downs, the fluctuation of our statements look like, but rather we need to be, especially when we're in retirement, or absolutely when we're in retirement, we need to have completely flipped our mindset. And maybe that's the problem, because as working, investing, saving individuals for 40, 50 years, sometimes 60 years, I mean, you can't just unlearn these types of financial lessons in a month or a year even. So maybe that's the problem as well. Our appetite for risk is based on things that we're not factoring in. And also we got to remember how we've educated ourselves in a financial space for 60 years. And now we're supposed to just think about it completely differently.
Well, and think about too, while you're working, right? Like you go to the office, you work, you're grinding, maybe you have kids, or you're married, or you got family or hobbies or whatever it is. You're busy all the time. Like, we're always so busy. And and you and I always talk about how it's like, yes, we have, like, I have the kids, you and Kyle, but we're so busy all the time. We're nonstop. And when you retire, you don't go to work. You have all the time in the world to read the news. And if you don't think that the news and the newspapers and the articles, they are hyper aware of your ability to read bad news. They will force feed it to you, and they will keep making sure you know how dangerous things could be or can be. And that's why I get the phone calls, because the articles keep hitting you, keep coming after you. You know, and it's so funny. It's like, just to get you to click on it, they will put the most egregious stuff on there. And then you click on it.
Correlate to the article. It's
nothing.
Clickbait. No.
And especially now, the way that articles are written, because they know that the average person doesn't read beyond 2.5 to 3 paragraphs in an article. So what they do is they put the hyperbole in the first 3 paragraphs and then the counter sentiment in the last 2 or 3 paragraphs. So that way they say the world's ending, the world's ending.
From the bottom of an article and then read up.
Yeah, it's almost like you want to read the argument against first.
The last paragraph first.
Yeah, and so it's just so ridiculous, because most people will not read all the way to the bottom to get the full picture. So I just think that the news and the way we receive information has changed. But I tell my clients all the time, the less you can watch the news, the less you can check in to see how the market's doing, the better your life will be. Because it's just not what it used to be 30, 40 years ago, you know, and the speed of information, the speed of the news cycle has moved so quickly, and the market has sped up right in lockstep with it. We just want to make sure that we're building a good quality of life in retirement. And that's not by living and dying with every day of the market, or everything that the president does or doesn't say, or every election cycle. I hate election years. It's exhausting. I would love for us to figure out a way in this country to not live and die by it so much. And everyone this year is the biggest. Every time we have an election now, it's the biggest one of all time.
Most important election.
Most important.
The biggest. Yes.
Yeah. And it's like, I feel like, did they say the same stuff in like 1912? Like, were they, is it always been this way? Or were they like civil and be like, hey, we disagree, but we both respect each other? You know, like, was it a different world? I would love to think that. But, at this point, travel the world, travel the country, work with someone who understands who you are and builds a great portfolio that gives you long-term perspective to make good short-term decisions. We don't want to just jump over boat because it's getting a little choppy. We want to make sure that we've got a lot of safety measures in place that when things go bad, we stay good.
Okay. Action items then for folks. One, they need to have protection around their income streams and strategies that are, am I saying this right? Quarantine a section of your finances, of your money, of your savings to generate income that is safe. Is that step one in this space?
So the phrase is purpose determines placement, right? That's the whole model. So what is the purpose of the money? This money is to give me income. Well, then that determines the placement. It needs to go into dividends, preferred stocks, or an annuity. That's it. It's as simple as that. And we don't want to overthink it. And then you do want to find the right type of annuity or the right type of dividends. But that's like the thought. That is the purpose of that money. It satisfies my income shortage. Social Security, pension, plus that chunk of money gives me all the income I need. Great. That determines the placement. Now, what's the purpose of this chunk of money? Well, 5 to 10 years from now, we want to redo our kitchen and do this, that. So it needs to grow a little bit. Okay, great. That purpose determines the placement. A moderate portfolio that gives you good growth and some market volatility. Then this last chunk of money is the money I'm going to leave to my kids and grandkids. All right, well, that purpose determines the placement of high risk, high volatility, long-term view because it will make double-digit returns over the years. Not a guarantee of future results, but it will give you the best opportunity for growth in the future because I don't need it for the next 10 to 15 years. Yeah. So again, the purpose determines the placement.
Okay. Having a plan that is built out with purpose and placement around your money and understanding the diversification in retirement. It's not just having a diversified stock portfolio. It's about literally having your money in different areas so that you have that feeling of security when it comes to knowing where your income is coming from, knowing where your risk is involved, and knowing how it's all working harmoniously together is the point of the kind of every single plan that Mike and his team build and can get to work with on you as well. So if you have questions, if you're worried about market volatility, if you just know that you couldn't stomach a 30% loss over your portfolio, let's get to work helping you understand your risk setup and how to better align it with what you can tolerate. MichigansRetirementCoach.com is the website and where to start the conversation. You can also click on the links we've got posted in the show notes. Or again, it's MichigansRetirementCoach.com.